Welcome back, everyone. In this episode of the Joseph Carlson Show, we're going to be taking a look at my entire portfolio, every stock I own. In fact, we're going to be looking at both portfolios I have, the passive income portfolio and the story fund, with a combined value of over $1 million. These are invested in only a handful of companies, a select few companies that I've picked out, and today we're going to be looking at each one of them. We'll be looking at the performance of these portfolios, which companies I'm currently buying into, which ones I'm just holding on to, and which ones I'm considering selling. So we have a lot to get to. Let's go ahead and jump in. Like I said, I have two portfolios. This one here is the larger of the two with a total value of $814,800. We have the other one loading in here, which is the story fund. This is my secondary, smaller portfolio, but it's still a meaningful amount of money. We have a total value of $266,000, and we'll start off with this one. Now, the story fund I started as more of an aggressive growth portfolio. It was a bit more aggressive than the passive income portfolio, but over time, they've kind of mimicked the same strategy. So we can start off by looking at the story fund, and I'll first give you a performance update. So far this year, the story fund is up 41.82%. At the same time, in 2024 so far, the S&P 500 and the QQQ are both up around the same 26%. So the story fund is doing really well in terms of performance against the benchmark this year. Now, when we compare it over a broader timeline since the very beginning of this portfolio, we also have that data right here. This is the chart where I track every single deposit into the portfolio. I benchmark it against the S&P 500, and we can see the performance over time. The story fund is in blue, the S&P 500 is in red. And right now, the story fund has a total performance of 70% returns, while in an alternate reality, if I had invested the same capital into the S&P 500 at the same time, I would have 51% returns. Now, that doesn't seem like a lot, just an additional 20%, but that's around $35,000. So over time, the accumulation of returns as these numbers diverge and the story fund outperforms, that does equate to a lot of money. Now let's go ahead and break down each company. I'm going to give you whether or not I'm buying these companies, holding them, or looking at selling them. First of all, we have Netflix, which is currently in my hold category. Netflix is a $92,000 position, 45,900 of that being gains. When we look at Netflix here, the company just recently, as of last week, surpassed $900 per share. So it's bouncing around between $880, $900, and $900 per share was a price target that I actually had years ago for Netflix. In 2021, I said that the company would likely get to $900 per share before 2026. And it's actually gotten there a couple years early. So I like the progress with Netflix. The company's had explosive growth. We've seen the performance of it. In 2024, the company's had 88% returns. In 2023, the company had 60% returns. So back-to-back, incredible outperformance by this company. Now, when I look at Netflix, the valuation it's trended up a little bit, the 37 forward PE ratio, a 2% free cash flow yield. It's moved out of that category of being a complete still. To get the company when it was a complete still, you had to buy in when there was doubt in the stock, when people are still scared about it, when they're worried about it, when the stock price was tanking, there's so much confusion and unclarity. You had to have a little bit of a future vision there. You had to look into the future and see that Netflix really wasn't beaten up that much. The company was going to be okay. No longer does that deal exist. That's why the company's moved into the hold position for me. I'm fine having this much exposure, but I'm not just throwing money into it at this point. Now, even given the valuation at a higher PE ratio and a lower free cash flow yield, it's still not crazy. I don't think Netflix is overvalued. I wouldn't put it in that category. In fact, I still believe the company's likely to outperform over the next year or two. And the reason why is because of the continued increasing strength and dominance of this company. Netflix has always been, since it became a streamer, the world's dominant streaming company, and it continues to exercise that dominance and gain further and further competitive advantage. The distance between Netflix and its next closest competitor is widening. It's not narrowing over time. It's actually widening. I see the company is getting more competitively advantaged over time than less competitively advantaged. So the moat of this company will continue to grow as the fundamentals grow. When I look at this, you may ask, what fundamentals am I looking at? Any of them, really any of them. The free cash flow the company generates. And this isn't diluted free cash flow with tons of stock-based comp. They have almost no stock-based comp. So the fact they're generating $7 billion of pure, efficient free cash flow is strong. That's a strong company. Right now, Netflix is generating more free cash flow than Tesla and Palantir combined while being a third of the market cap. So this company generates an enormous amount of free cash flow. The balance sheet is also strengthening over time, not weakening. They're gaining in cash. They're lowering the amount of debt. They only use debt strategically when they can gain more by the cash they hold than the debt they hold. So their balance sheet is incredibly strong. The shares outstanding continue to go down. In fact, they're cannibalizing their shares outstanding now. It was down 2.7% year over year. These are all indications of a very strong company. Then when we look at the qualitative aspects of Netflix, I continue to think they're just getting stronger. They're not getting weaker. For example, if we look at what Netflix is doing next month, this is their lineup. Let me load it in here. This is their lineup that Netflix announced just last month. Let's go ahead and just take a look at some things they have lined up in terms of content. They have Squid Game Season 2, one of the most highly anticipated sequels in existence today, is releasing. It's releasing December 26th, so a day after Christmas, you get Squid Game. But then they have like 10 other series being released on Netflix come December. Some anime series as well, maybe like 15. But then we get to the movies and the special stand-up comedies. They have around 10 different stand-up comedies from major comedians being released just in December. This is 1 month, all this content's coming out. They also have like 6 new films coming out next month, one of them being Carry On, which if we look at the cast of this movie, it has Taron Egerton, Sophia Carson, and Jason Bateman. It's a pretty stacked cast. In fact, they have Dean Norris, who's another actor I really like. So this is one I'm going to watch. It seems like it's very intriguing. Jason Bateman's playing a bad guy, which is something that I think is interesting. So this is going to gain a lot of attention. They have a lot of movies coming out next month to close out 2024 or Q4 of 2024. Then it goes on. They have tons of documentaries, live events, Christmas specials. They have 2 different NFL football games being streamed on Sunday on December 25th. So 2 huge events. Hopefully they get the streaming down right. Hopefully the quality's good. But either way, it's going to have a ton of attention. Then they have Christmas specials, people like Sabrina Carpenter, so on and so forth. The content slate just next month is stacked for Netflix. And then they do this thing where they continually just add on more movies on a whim. Like one of them is It Ends With Us. They just announced like a day ago that this is going to be on Netflix next month. So they're throwing everything next month. They're throwing a ton of good content. I think Netflix is going to close out Q4 2024 very strong with another 6 to 8 million subscribers gained, another big step up on their long march of total subscriber gains to 300 million subscribers. It's incredible what this company's doing. It doesn't get enough credit. No other company on earth is able to replicate what Netflix is doing. At the same time, next year in 2025, after they report Q4 of 2024, they're no longer going to be reporting subscribers gained or lost. So investors in Netflix are going to have to look at the fundamentals. And luckily for Netflix, they have incredibly good fundamentals. Even given the fact that it's been rewarded dramatically over the past couple of years, I still look at this company as a key position in the portfolio. I still think over the long term, it's still going to outperform incrementally both the S&P 500 and the QQQ. I have a high level of conviction of this company. I put it in the hold category just because I already own so much. Now, next up, we have Amazon. This is another company that seems like an obvious bet, but it's one that I've heavily weighted in my portfolio because I think the company is undervalued when you benchmark it against the other relative benchmarks. Amazon has been doing a little bit better. The company has been performing okay this year, beating out the indices. It's up 37%. So it's beat out the S&P 500 and the QQQ this year. When I look at Amazon, I think today Amazon is undervalued. The only reason that I'm not actively buying it is just because I've already bought so much of it. I own $86,000 of this company, and I've actually put in more money into Amazon than I have into Netflix. The reason Netflix is a bigger position is just because of the gains. So Amazon is one that I've put a lot of money into. I've built my stake in the company. I have my bet on the company. So I'm not buying it today, but I still think today it's undervalued. I think the value of it today could easily go to 220. I think it's likely going to race upwards more than that. When we look at Amazon, the case for this company is very simple. Okay, Amazon will continue to grow overall as a company, but its growth is slowing as a total combined company to around 12.3%. But as an investor, that's okay, because when you look at the most important parts of the company, they're growing much faster. For example, if we filter out everything except for the two most important parts of Amazon, advertising and AWS, the growth is 21% year over year as of last quarter on a trailing 12-month basis. So when you look at this normalized, you have 21% growth for these two segments of business. These two segments of business are very repeatable. They're almost like subscription-based portions of the business. They're repeatable, they're reliable, they're dependable and predictable, and they have high margins. I assume that the advertising portion has margins above 50%. AWS has margins above 30%. So they both have very high margins. Now, even if you looked at this and you assume that they had lower margins, around 30%, just to be super conservative, it's doing $160 billion over the trailing 12 months. But even if you just assume that it's flat, that's around $48 billion of free cash flow just for these two forms of business, without anything else, without the sales portion of Amazon, without them selling anything. And of course, they can make money through their third-party seller services, through their subscriptions, through their physical stores and first-party online sales. All of these businesses can be profitable, but even if you just assume they're making money on advertising and AWS, it's still a great company. As this marches higher and higher, the intrinsic value of Amazon continues to march higher and higher. So Amazon for me is a hold, even though I consider it undervalued today. Now, next up we have Google. This is another company that I believe is undervalued today. I own $43,000 of Google in the Story Fund, with $14,000 of that being gains, but I also own this company in the passive income portfolio. If we open that up, we can take a look at it here. Let's let it load in. We have the passive income portfolio, and Google's a company that I really think is undervalued, and I have been buying more into it. $34,000, it's basically flat. It's down $100 right now. So why am I buying into Google an additional $34,000 over what I already owned in the Story Fund? Because I believe there's a strong possibility that Google's really undervalued right now. When I look at Google, I see it as an asymmetric bet, a company that I don't believe has too much downside in the next couple of years, but I think there's a chance for ample upside, for 50%, 70% gains in this company. The reason why is because of the simple valuation metrics. Google trades at a 19.4 PE ratio, while the S&P 500 trades at a 26, while the QQQ trades at a 31. So it is dramatically lower valued than both indices that I would compete with Google. My goal is to outperform the S&P 500 and the QQQ. So when I see a very dominant, high quality company that's growing its intrinsic value quickly, and I see it trading at a very low price, that catches my interest. Now, why is Google trading down so much? Why is the company undervalued? It's because of what The Verge calls Google's empire is under siege. There is an onslaught of antitrust that could drastically change what Google looks like and how it operates, even if they don't succeed. So I understand that during this time period where Google's facing a ton of regulation and a lot of investors are trying to decide what this will look like over the next upcoming years, this is getting heavily discounted into the stock. Google's being treated as though it's a company in extreme distress, a company that has existential crisis facing the company. And when I look at it and I try to exercise my best judgment and how this will play out over the next couple of years, I don't think the damage is going to be quite as bad as investors are predicting, or at least what's being priced into the company. Furthermore, I think that Google is a company that's very well positioned and has a lot of experience dealing with changes in its business, dealing with different competitors. There's always been different places to get information, and Google somehow leverages all of its different utilities, its different businesses to help each other. So I think this is a company that will be able to overcome the challenges it's facing. That's the bet I'm making. So when I look at it in my portfolio, I think if that's correct, if my overall thesis is correct, this company is undervalued, and it's going to go up a lot in value in both of my portfolios over the upcoming years. But again, if you don't agree with that, if you think the regulations are going to be a serious problem, then this is one to avoid. Now, after Google, we have S&P Global and Microsoft, which are both companies that I've held in my portfolio for a long time. And these are both companies that I'm so bullish on, I've bought them in both portfolios. For example, if we switch over to the passive income portfolio, once again here, we have S&P Global as one of my largest positions in this portfolio. If we go down to the finance category, here it is, S&P Global, a $107,000 position, $33,000 in the gain. It has around 50% returns. When I look at S&P Global, This is one that I still believe is undervalued. Now, why do I think the S&P Global is undervalued? Well, it's a combination of the current valuation of the company, the free cash flow yield, and what I think this company does in terms of quality and growth prospects. When we look at S&P Global, this is still a fast-growing company that has incredibly good properties that they own. It trades at a 3% free cash flow yield, which I think is too high. The company should be at a 2.5% or 2%, along the same pricing that other high-quality companies are at. And if we look at S&P Global in particular, this company will continue to grow its rating business at a very high speed. We'll see a wall of debt maturities, companies that need to get new debt issued, and you're going to see this ratings revenue continue to climb. This is very high margin revenue. So we're seeing this climb 30% year over year as one of the largest portions of their business. They're going to generate a lot of money over the next couple of years when companies take out more and more debt. Then on top of that, the other businesses that they own are not problematic. They are incredibly good businesses. Market intelligence is selling data. Commodity insights is selling data on commodities. We have mobility, which is selling data on mobility. And we have indices, which is licensing out the S&P 500 or the Dow Jones indices that basically every benchmark benchmarks against. So they make money in a lot of great ways, but the ratings business is going to grow over the next year. And I'll say the same for Moody's. It has virtually the exact same investment thesis. I believe that this company is priced a little bit higher. See, it's already around that 2.5% free cash flow yield. I think S&P Global deserves to be valued at the same price. Investors disagree, but I think that'll eventually happen. So S&P Global is one that I'm not buying right now. Again, it's another one that I have a lot of stock already in, but I may buy it in the future because I think the company is currently undervalued. When I look at Microsoft, this is one that I'm also not buying. I think that this one is fair valued, but I think it's teetering across overvalued. This is one that I think is at a very full valuation. When I look at Microsoft, again, this is one that I hold in two different places. I have it in the story fund, $21,000 position, $8,700 of that being gains. I've had around 100% money weighted return in that one. When we switch over to the passive income portfolio, I've held Microsoft for a number of years in this one, but I really doubled down on this company when it traded down to around 220, 230. So I added a lot at that point. It's another $70,000 position, $26,000 in the green in this one. So overall, this has been a fantastic holding. Microsoft is just too difficult to bet against. And it's also a difficult company to not have in your portfolio because this thing will continue to grow over time. The intrinsic value of Microsoft will continue to march upward every single year. So unless you can find companies growing their intrinsic value faster and more predictable than Microsoft, this is one that's good to keep in your portfolio. When I look at Microsoft right now, the story is essentially unchanged for this company. It has intrinsic value drivers that continually grow every single quarter like clockwork. And the big story with Microsoft is the cloud business. So as cloud continues to grow, this company will continue to do better and better. And I think that cloud has a long runway of growth. That's why I hold Amazon, Microsoft, and Google. I like holding all the hyperscalers. I think they're easy companies to outperform the rest of the market. But Microsoft trades above $400 per share. It trades at a low free cash flow yield. For me right now, again, it is a hold, and it's not a company that I consider undervalued. So we've gone through the story fund. That's the smaller of the two portfolios, and we touched a little bit on the passive income portfolio, but it's time to jump into this entire portfolio. This is the big one. This is where I have most of my money, and it's the portfolio that's the oldest. Now, overall, we have a total value of $814,000 with $323,000 in gains. Now, keep in mind, I did not start with this much capital at the beginning. I've been slowly adding money over time. So the performance has to be calculated when you put money into this portfolio. That's what time-weighted and money-weighted return means. It means it's calculated when you start adding money to the portfolio. When I look at this on time-weighted returns, the calculation from 2022 was minus 16%, while the S&P 500 dropped 18%. So we did a little bit better that year. Then we have 2023. This portfolio really had a good year in 2023, up 32%, while the S&P 500 was only up 26%. So we had marginal outperformance in 2022. We had decent outperformance in 2023. And then in 2024, year to date so far, we are up 26.19% against the S&P 500's 26.88%. So we're right there hugging the S&P 500 so far in 2024. Of course, the goal is to outperform the S&P 500 every year, but especially over a longer timeline. So right now, I consider the performance good. We're beating out the S&P 500. That's my benchmark. This may not seem, again, like a big difference, but when you're working with larger and larger numbers, the variance in performance means bigger and bigger degrees of money. So I take the performance and compounding of this portfolio very seriously. Now let's go ahead and go through these holdings one by one in this portfolio. If we start off in the largest category, the finance category, we've already talked a bit about S&P Global and Moody's. I love both of these companies. I want to own more. I would be happy actively buying more of these companies. In fact, I just recently added a little bit to Moody's to bump up the size of this position, but I would love owning more and more S&P Global as well. But if we look at the other positions here, we have Mastercard. This is another one that I think has done incredible. Mastercard is just such an incredible company. And it's one that I think is a relatively stable and predictable company into the future. There's a lot of bets about finance. Whether or not you're betting on companies like Toast or Four, whether you're betting on companies like PayPal, or you're betting on crypto, whatever it may be, I think that Mastercard wins either way. Mastercard is a bet on global digital payments. It's a bet that more and more people will switch to digital over time from cash. There's still trillions of dollars of cash, and that will transition to digital over time. And this company has such a massive network that it's nearly impossible to avoid. I'm not buying Mastercard today because I have a lot of the position and I consider it at a rather fair value, but I still think given a longer timeline, this company will outperform the S&P 500. Now next we have Intuit. This is another company that's a large holding in my portfolio. It had a really good 2023, but it hasn't had a great 2024. So if we look at Intuit, this is a company that went up only 5.5% in 2024. When we look at it on a little bit longer of a timeline, in 2023, that was a time to be buying the company. But either way, when I look at Intuit now, I still hold on to this company, and I've even been adding a little to this position because I think it's in such an incredibly strong place. When I look at what they're doing, it's so smart. They're following the playbook that Adobe has already laid out. If we look at Adobe and their revenue line, you'll notice different trends, different changes in growth rates over time. For example, there's this entire time period right here for like 10 years where Adobe didn't grow that much. And then all of a sudden something shifted. Around 2013 to 2016, they implemented some changes and then it was off to the races. And Adobe's had remarkable growth over the past decade, growing in the high teens. If we look at Intuit, you'll notice a similarity in their growth trajectory. We look at the revenue, and again, they had this time period from around 2009 to 2015, not a lot of growth right here. In fact, it continued on a little bit, but in 2017 and 18, all of a sudden the growth starts to speed up like crazy. What did both of these companies do during these time periods? Well, they shifted from a one-time legacy business of installing all of the Adobe products, paying for them for like $1,000 once, and being done, to subscription business model. Intuit is doing the same thing. They're in the process of shifting from a one-time legacy business model to being an online through the browser subscription business model. And they're in the process of shifting all of their clients from one of those models to the other. Now you can see where they've made that shift. Around 2017 to 2020, they've started working on it and implementing it. You can see the massive growth speed up since that point. This is going to continue onwards. Intuit's around 80% of the way through that transition. As they work their way through that transition, you're going to see the earnings per share grow at unusually high rates. The earnings per share growth will grow faster than expected with the subscription business model. That's the same thing we saw with Adobe. So I see this as following the same blueprint that we saw with another company. Intuit's later to the game of doing this, but I think they'll have a lot of success because their platforms are mini monopolies. In tax and small business accounting, Credit Karma, they own incredibly wide range of products that are very dominant. So even though the valuation metrics on a forward PE ratio look a little high, or the free cash flow yield, this is one that I continue to expect a lot of growth over the next 10 years. Intuit's also built up a nice development team. They're pushing into new verticals, building out AI tools. They're developing organic growth. So I like what I see with this company. As for me right now, I think it's around fair value, but it's a company that I've wanted to build a little bit larger of a position in recently, so I've added more to this position. In tech, my largest position today has bumped up to be Salesforce. This is a new position for this portfolio. Salesforce is an example of a company where I do the buying strategy of buying a half-size position as my entry position into the company. So before the earnings report, around this time period, I thought that Salesforce was a decent buy. I was buying into it at $300, $280. I bought around $25,000 of the company because, again, I thought it was undervalued at that price point. Similar to Netflix, it dropped afterwards, but it wasn't as huge of a drop as something like Netflix. It only dropped around 16%. That's scary, but not the worst thing in the world. What I did during that time period was I bought more of the company and I brought down my average price I paid for my shares. So I was buying more of the company here. Now you might notice that buying it throughout this time period, whether you bought it here or here, both of these purchases are in the green right now. So I've never done a Salesforce purchase that is in the red. Not buying it before the drop, not buying it afterwards. This is why investing requires patience. When I look at Salesforce today, I'm no longer adding to my position, so right now it's just a hold. I think it will have a future expected return that's above the market, above the S&P 500. I do not believe the concern and the craziness in the market saying that software is dead, AI is going to replace it, Salesforce is a thing of the past. That's not the case. Salesforce runs people's businesses. They put all their data on Salesforce. They have the Sales Cloud, Service Cloud platform. They have their Salesforce Exchange. They have marketing and commerce, integration and analytics. This company is a full suite for companies to run on. So this is one that I continue to see growth of, continue to see intrinsic value creation. They've recently come out with their Salesforce AI agents. Mark Benioff is pushing those hard. I think those are going to make a lot of money. So this is a company that I'm still holding on to as of now. Next up, we have Apple. This is one that I haven't been as bullish on recently. And that's a change in tone because for the past 7 or 8 years, from around 2017, I've been bullish on Apple. I'm an Apple fanboy. I love the products. I love basically everything that Apple does. But it's just a mathematical question. Apple has grown to such a large size. The company's so huge, and they're at a point where they're struggling to innovate to a point of creating new opportunities for growth. Intrinsic value is the combination of predictability and growth. With Apple, the lowered growth brings down the intrinsic value of the company. They are simply just not growing. They're not growing that fast at all. If we look at the revenue over the past 10 years, this is what it looks like. This looks like the revenue growth of like a railroad or something that's a little bit more stagnant. They grew their revenue by 2% year over year. They grew it a little bit over the past 5 years, 8%, but those are now single-digit growth. Now, Apple can still generate a lot of profit, a lot of cash flows by pumping buybacks, but I like companies that pump buybacks and they grow their revenue very quickly. That's why I have a preference for companies like Netflix over Apple. Netflix is growing revenue and pumping buybacks. Apple's just pumping buybacks without growing their revenue. So I think the math is a little difficult here. Apple trades at a high valuation, a very high healthy PE ratio, a very low free cash flow yield for a company that's trying to squeeze out any growth that it can. For that reason, this is a company that I've been actively reducing my position in and selling out of all throughout 2024, and I've been buying companies that I think have more growth ahead. Now, if Apple changes things, if I see much more growth in the future, if they release some innovative, groundbreaking product, I'll jump back into the stock. But unless I see that change, I'm going to continually reduce my position. Now, next up, we get to some exciting companies here. In the consumer category, there's 2 companies that I really love here. We have Costco and Booking Holdings. They're on a little bit of the opposite spectrum, even though they're both consumer companies. For example, Costco is one that I consider to be extremely defensive, a non-volatile company that's all weather. Booking Holdings, of course, is a little bit more reliant on the economy, on vacationing, so it's a little bit more volatile of a company. But if we first start off at Costco, my current thoughts on this company are going to be shocking, but they are my current thoughts. I believe the company is overvalued. Now, I say that because when I look at any of the metrics, the company trades at such a lofty valuation, a 54 forward PE ratio, a 1.5% free cash flow yield. Now, why do I hold this company even though I consider it overvalued by the numbers? That's a question a lot of people struggle with, but I think it becomes less overvalued when you look at it through a much, much longer timeline. When you look at Costco by owning it 30, 40 years, just the rest of your life you own this company, I think it goes from being overvalued to not overvalued. So in basic terms, when we talk about undervalued or overvalued, most people are talking about the next 5 to 10 years. People aren't really talking about the next 30 years. They're not looking out way down the future until they're retired. When I look at Costco, that is the viewpoint that I'm looking at it from. I'm looking at it as a company that I can be an old man and retire while owning this stock. When I look at it from that perspective, I'm still willing to hold it even at the price it trades at. Because I think in the long term, in the fullness of time, the company is not overvalued today. In the short term, sure, it's trading at a very high valuation. So this is one that I give a little bit more slack for because I think the qualities of Costco are so unique as a retailer in today's world that I think it's going to be very difficult to try to come up with anything else that resembles their business, that really replicates their business or outperforms their business. If you really want to do research on Costco and be convinced of its future, just go there. Literally, just go to a Costco and see what happens. Go on Thanksgiving week and just see what you notice. You'll notice that it's completely packed, that people are in love with Costco, that it's their go-to destination for getting everything for Thanksgiving. And all the other stores are kind of like secondary. After you go to Costco, you go to this one, that one, and the other. But Costco is the main destination. They have so many people trying to cram into their warehouses Thanksgiving week that it's honestly nuts. It's a crazy experience. You'll never see anything like it. This store has figured out the recipe, and all they're doing is continually executing. They never have to change anything. They can just do the same thing for the next 30 years and generate enormous amounts of cash flow. On top of that, Costco should not be valued like a normal retailer because they're not a normal retailer. They are a subscription business. Not only are they opening up more and more warehouses every single quarter, but they have more and more members sign up for their membership. They have 136 million cardholders. I think over the next 10, 20 years, they're going to get to 200 million, 250, and that's highly reoccurring subscription revenue. In fact, it's such a high renewal rate that it's just incredible. They keep 92.9% of their members every single year. Any type of subscription company would die for these type of metrics. There's nothing like it. So even when you compare this to a SaaS company or whatever type of software company you're comparing it to, they do not have retention rates this high. Guaranteed, none of them do. You can look at the retention rate and they'll try to hide it because it's nowhere as good as Costco's. So this company's figured out something special. They continue to execute, and I'm in it for the long run. I'm not selling my Costco shares even though they're overvalued in the shorter term. Now, the next one we have here is Booking, which is an entirely different story. I think that right now, Booking is still at a decent valuation. I would say that it's shifted back up kind of to the more fair valued range right now, but I say that with a bit of softness. I really think that Booking Holdings is teetering between still undervalued and fair valued. I do not think the company is anywhere close to overvalued. And the reason I say that is simple. Just look at the valuation metrics of the company, compare it with the growth and the long-term stability of the company. When you factor in the predictability, the current valuation, and the current trends, this is a company that I still think has a lot of intrinsic value creation ahead of it. It trades at a 25/4 PE ratio, but the free cash flow yield is 4.6% when you adjust out stock-based comp. 4.6% for a company that continually boosts more and more cash every single year. It generated $8.5 billion in free cash flow over the trailing 12 months. It's going to continue generating more. Booking Holdings is also a return of capital machine. They return capital back to the shareholder every single quarter. They reduced their shares outstanding by 5.9% over the trailing 1 year. 5.9%. So you're getting roughly a 6% yield just on buybacks, which is incredible in and of itself. But then we also have the dividends that they're paying. They pay a per share dividend of $8.75 every quarter. This is presumably going to be raised every single year. So they're now a dividend growth company as well as a buyback machine. I like everything this company does. I'm very bullish on it. This has been a quick winner in the portfolio, but I continue to hold. Now, next up, we have one of my favorite companies, which is Texas Roadhouse. This is currently my third largest position in this portfolio. And if you study Texas Roadhouse as a business, if you bring up the charts in Qualtrim and you look at the long-term history, the revenue growth, the EBITDA growth, the free cash flow, the balance sheet and management of their balance sheet, the shares outstanding, you'll notice that this company has a long proven history of outperforming some of the best companies in the world. For example, it's outperformed Google over the past decade, and it's outperformed it over the past 5 years and 1 year And Google's not the only one. It's outperformed many great companies that you would recognize. Lots of big tech companies. They do that by an incredibly strict, well-executed strategy. Texas Roadhouse does not waste any money. They don't have any big CapEx investments into AI. They don't do anything that's unpredictable. They just open up more and more restaurants and they execute on that incredibly well. Now, this is an $88,900 position. $54,000 of that is gains. So the majority of this position is now gains. It's one that I continue to hold. I'm not buying it and I'm not selling it. Now, when we look at this company, it just surpassed $204 per share. My average on it is $85. So that's the average price I've paid. Not only is it up to $204, but that's not the total return because it also pays a nice dividend. When I was buying the company, it had around a 3% yield. So I get these nice dividends every single quarter from the cash flow of the company. They have the money to do that as well as buybacks. Now, when I look at the valuation right now, the reason that I'm not buying more of it and that I consider it just fair valued is because the valuation has raced up to reflect the better fundamentals of Texas Roadhouse. A 29.4 PE ratio is very high compared to their history. So right now today, it's much more expensive, but the fundamentals are still there. When I look at the company right now and the business that they operate in, it is cutthroat, it's highly competitive, there's lots of places to eat, but people want to go out and have good experiences. They want to have predictably good experiences. When they go out to a restaurant, they want to know that there's a really good chance they're going to have a good time. Texas Roadhouse provides that. You go there and it's a fun atmosphere. It's very predictably good food. If they ever screw up anything, they remake it for you for free. It's a friendly environment. I like that the company runs this really organically growing business that doesn't rely on advertisement. You're not going to see a lot of Texas Roadhouse ads or national ads because they work with their local communities. Now, the last one we have here is VICI, the Real Estate Investment Trust. This is a high-yielding dividend company. It pays a nice big quarterly dividend, has like a 6% yield right now. And I've made some gains with this company, so it's been one that's been profitable. $11,500 in the green. It's remained a half-size position because VICI is a company that right now, I think the valuation is fine. I think the future of the company is fine. When I look at the fundamentals, I don't see anything wrong with VICI. It's not a company that I'm concerned about by any means. I think it will survive a recession or any challenges in the future, but it's also one that I think is just a bit too slow of a pace for my portfolio. What I'm looking to do over the next 5 years is double the portfolio value. I want to go from 800,000 to 1.6 million. I want every company to grow its intrinsic value by 15% per year over the next 5 years. When I look at VICI, I don't believe I'm going to get that level of growth. I might get 8 to 9% growth per year. So for that reason, I'm looking at other opportunities. VICI is a company that I don't think hurts anything. Having it in the portfolio has been profitable, but it's one that I could start to trim or sell out of to buy another position that I think has more aggressive growth assumptions in the future. And that's the entire thing. That's the entire passive income portfolio, every single holding. So hopefully this gives you an overview of what's going on in my head when I look at my portfolio. Obviously, I'm overall bullish on every single company I own. I think they're gonna do great. Otherwise, I would not own them in these concentrated portfolios. That's gonna be it for now. Enjoy the holidays. See you in the next one.